Hello, everyone, and welcome to another edition of our COVID-19 Power Lunch, our weekly video series where we talk about new developments and new legislations related to the coronavirus pandemic. As a quick reminder, we've transitioned to a weekly episode format that will air every Tuesday at noon. My name is Erin Spiwak, and I'm a partner with James Moore & Company and have been a moderator for this series. For many business owners who've received a PPP loan, the 8-week utilization period for that loan is coming to a close. There have been a lot of questions regarding the loan forgiveness process, and fortunately, new guidance was released last week on this topic. With me today to discuss the new guidance and PPP loan forgiveness is Mike Sibley, a partner with James Moore. In case you missed it, we do have an on-demand webinar on this topic where we go over the application itself, demonstrating our in-house loan forgiveness tool, and walking listeners through a step-by-step example of the calculations involved. A link to that webinar is in the notes below, as well as on our website. So please feel free to register for that if you haven't already watched it. Mike, can you walk us through some of the new guidance and how that applies to business as kind of an overall update on the PPP?
Yeah, so the overall guidance that came out in the last really week and a half or so was able to take the application that came out and then actually gave us some interim guidance to work off. Actually clarified some of the questions that we had, and on other hands actually created some additional confusion. So as we've been saying for basically 2 months now or so, we need more guidance on certain areas. A few things that we really do know, obviously, the payroll piece as it stands is 75%. We go over this really in good detail on the webinar that you mentioned, but is 75%. Of course, it's a ratio, so it's not all or nothing. I know there's still some questions I get, is it all or nothing? And no, it's a ratio of down to the 75%. We also know that the safe harbors that they have in place restore everything. If you're back to your sort of restoration levels as of June 30th, meaning pre-COVID and basically the periods you were prior to the middle of March, a lot of the forgiveness worries that people had will go away. That's related to how many FTEs you have, and of course salary reductions. So there's those, but there's so many different dates involved in terms of measuring your FTE periods, in terms of measuring your safe harbor periods, and so it can get very confusing as you go through the process. So that's what we're trying to lay out in each of these sessions, particularly that webinar. One of the great things that we did find out is you're not going to get a double hit against you. In other words, if your FTEs go down and that same person maybe had there's a salary reduction issue, you're not getting hit with both sides of things. So for example, if somebody's hourly wage stays the same as it always has been, but their hours are decreased, you will have a reduced FTE, but you won't have a hit for the wage reduction. So going through that process, you've really got to do that analysis for employees. It's an employee by employee analysis. Now there's some businesses that maybe had no changes in FTEs and no changes in salaries, and that won't really be as much of an issue. And of course they measure the non-payroll costs, and of course all of this goes into their application. That the application itself, really the application is 2 pages. It's an 11-page document, but it takes a lot more than that to get in when you start measuring your FTEs. You measure your tracking costs, and of course it lists out a page of documentation, example documentation. You may actually need more depending on what things you have going on. So there's a lot to this application that's going to come into play.
Mike, thank you. That definitely summarizes it. Although we got guidance, we still need additional guidance, but every week seems to bring a little bit more clarification. And I know one of the big things that is there still is money left in the PPP. I think approximately 150 billion is still available. So people are still continuing to apply for the loan. And most of the new loans seem to be 50,000 and below. So it's a lot of the smaller employers or perhaps the self-employed people who are still applying. But one of the things that I know is out there is something called the Paycheck Protection Program Flexibility Act. Do you want to kind of tell us a little bit about what's brewing there?
Sure, and I do think that as businesses become more confident that this loan is actually going to help them, you're continuing to see some of the small businesses actually apply. And of course, at an average of 50,000, it's going to take a long time to get to 150 billion. But there was concern because they weren't sure about how this ratio is going to work with payroll costs, or perhaps they weren't even back in business yet, and now with states opening back up, then now they're getting a little confidence that, yeah, they can actually use the loan to help them restart. But still, 8 weeks is a tough period, and there's been a lot of discussion about, for some businesses, to get 8 weeks of payroll and then have it forgiven is almost not useful. So the House just passed that Paycheck Protection Program Flexibility Act, and of course it was passed 417 to 1. I mean, that's a tremendous bipartisan approval there, which is really going to put some pressure on the Senate. And of course, the Senate has a version too. But if we talk about what this act would allow for, again, it's still got to go through the Senate and still got to go get signed by the president. So there's still some distance to go on this. But it's actually going to change the 8-week requirement to 24 weeks, which is a pretty substantial change. And in some ways will simplify for a lot of businesses this worry about, how am I going to get to 75% or 100%? What's going, will I actually have enough payroll? So 24 weeks extension is a pretty significant amount. They're also looking at changing that requirement. There's the overhead requirement. So the rent, the mortgage interest, those lease payments that would max out at 25%. Now they're actually looking to go to 40%. So your payroll would only have to be 60%. And there's some concern, the way the bill is written, that 60% was actually more like a cliff. So if you didn't hit 60%, you didn't get anything. That's not the intent. If it doesn't get fixed with the Senate, it's going to be there'll be a technical correction of some sort. So I don't see that being an issue. But they're talking about it being 60%. For payroll, for the minimum for payroll, and then 40% to allow for more of those overhead costs. So that's a pretty big game changer in this whole thing. I think it's going to be very beneficial for many businesses, especially those who are struggling to figure out how they were going to get restarted again. It provides more flexibility. And of course, we just talked about the safe harbors, where June 30th, if you restore your FTEs or you restore salaries by June 30th, you meet the exemptions, and then you won't take the hit against your forgiveness. Well, this bill actually says that date will be December 31st. So, because there was many businesses, and I've heard from many in our Q&As in the past and emails I've received on questions, worried that they may not even get to June 3rd. They may not even be able to meet the June 30th because things are still ramping up in the community. There's still businesses that are at, capacity levels that are not maxed out. And so there's still a lot going on for these businesses before they can get to that point. And so by making it December 31st, that just provides a lot more flexibility. And, I think this is the right direction for us to go as a country to be able to make this happen. Initially, this was supposed to be a relatively simplified grant program, basically, right? It was the way it was talked about, but then it became very, very complicated, very political. It's had trouble with its rollout. I think now things are obviously a lot more smooth with the numbers going through there. So this extra added piece of flexibility is really what it needs to be to get back to that idea of a grant to keep people paid. Again, there's also the issue, this was putting employers against employees who were at home collecting unemployment, and perhaps maybe collecting a little bit more unemployment than they would with their regular wages. They didn't want to come back. So there's additional exemptions there. So I really think this is going to help alleviate some of that. Of course, the Senate version has 16 weeks versus 20. So they're going to have to see if the Senate will come on board with the House bill, or if they're going to have to work this out and come in, get some committees together to work through this. But I do expect, obviously, a change is going to happen. It's just a matter of how much is that change and where are they going to end up.
Yeah, and what's realistic is that they're not going to make this change anytime in the next week or so. They've already said that it could be up to a month before they can pass a bill. We've been surprised before, but that leaves a lot of businesses that are coming up on their 8-week period kind of in a pickle, right? Because they can't depend on what's in proposed or been passed by House or proposed by the Senate to extend it beyond the 24 weeks. So that is causing, I know, a lot of stress among people. And at this point, I think what we've been telling people is make your best efforts. And if you, at this point you owe more money back than you thought you were going to, you may get alleviated when the Senate and the House perhaps pass something in the near future. Correct? I mean, because you have to deal with what's law today, right?
Right, and that's exactly right. We're talking about what is the law as of right now. And yes, I even this morning had questions and email about, hey, I'm coming up against my 8 weeks here, and I was planning on doing this strategy or this strategy to make sure that we're able to keep and retain employees and pay them fairly and all that kind of stuff. And what do I do? And you just try to say, well, here's what's coming out. Here's what I think may happen, but here's the rule now. So
Yeah.
you have to make your own best judgment. And we're doing a lot of planning with clients right now, going through these calculations and safe harbor calculations and trying to make the best determination. But hopefully this doesn't take a month. Hopefully this comes out soon. But I'm not sure that this week or next week will be possible. I think we got to. I think the one thing that the community, the business community, and community at large can do is put pressure on your legislators to get this done
Right.
sooner rather than later, because this week, yes, at the end of May was theoretically 8 weeks since April 3rd. Now, every week that goes by, more and more companies now come into that 8 week period. When there was a good, by the end of April, there was a large chunk of companies that had their loans already. And so that means by the end of June, they're in that position of having to figure this out. So I really hope they're able to get something together in the next couple of weeks, but that remains to be seen.
Yeah, we'll see, right. Well, so as we kind of transition to talking about the planning that we've been doing a lot with clients, is that a lot of them are coming up on that 8-week period if they got their loan money early, is we have some clarifications, yet we mentioned before, some things that prompted more questions. Can we talk more about the 56-day, 8-week rule, paid versus incurred, that has been kind of a question we've gotten, and there seems to be very differing opinions on that throughout not only the accounting community and banking community.
Yeah, that's a really good point. This is one that's really hitting a very hot topic right now. And of course, I listen to other webcasts, and of course you do too, and others in the firm, trying to get try to get different perspectives. Maybe there's something we're missing, something we're seeing. And this is the one that keeps coming up, because the way they laid it out is they said, okay, when you get your loan, and again, let's reiterate what they kind of came out with as their general guidance is, let's say you get your loan on Wednesday and you pay your next payroll on the very following day, that Thursday. That payroll can actually be included as your forgiveness, because your covered period begins the date you got the funds. So now that might encompass 1 week or 2 weeks worth of previous payroll that is now being paid. And then from there, if you select that as your method, that covered period, you got 8 weeks from there. So all the pay periods from there, 8 weeks you've got. So the goal, at least, and it says it in the guidance over and over again, 8 weeks or 56 days, multiple times. They said, or what you can do is, and they give a very good example of this, it's pretty easy to follow in the guidance. They say, or you can pick just for payroll what's called an alternative period. And that will say, let's just say your next pay period begins the following Monday. And this is, of course, is for companies that have a bi-weekly payroll or less, or more frequent. So let's just say that starts on that next Monday. Okay, well, you can start. So the payroll that you just paid on that Thursday, we're going to exclude that from our 8 weeks. We're going to pick this alternative. And we're going to go from there, and we're going to go out 8 weeks. Well, it's possible that when you get to your 8th week, that final payroll that should be included doesn't get paid until a week or two later, based on just your normal runs. Well, they said, well, you can also include that because it's been incurred, and that's the alternative period. So you get back to 8 weeks is what it seems like it really wants to say. However, the way that it's written is not very well, because it says paid or incurred. So I think people are interpreting it to say, yes, you've got this, you go back to our covered period where we just got our loan, we're going to pay our first payroll that next day, that's going to be included, and then we're going to go out and we're going to have incurred payroll, and then we can pick it because it's paid on the very next one, we're going to pull it back in again. So
Right.
it's kind of taking the two different methods and combining them together. I just don't think that's the intent. I think the intent was to get 8 weeks. I think that's what it's going to be. Of course, if the law gets changed to 16 or 24 weeks, I think all of this is a very big moot point. But for now, this is what we're dealing with for trying to give some guidance to companies that are out there trying to plan ahead right now, because again, we don't know when this is all going to come into play.
Yeah, and I think that's been one of the hardest things, because again, we see differing opinions where people say, hey, I think you can squeeze 10 weeks in with this paid or incurred period. And it just seems to be antithesis to the law, the 8 weeks or 56 days. However, if we're wrong, better off for everybody else's companies, right? Because if you can squeeze that period on, that's good. We really need clarification, because what we don't want to do is advise people to rely, yeah, you are going to be able to use 10 weeks, and then it come out with a clarification or frequently asked question that says, nope, that's not the way it works, and you kind of end up going more back. So we're being a little bit more conservative in how we're reading it, but truly on the intent of what the law is. And if you read it in the interim rule, it seems to indicate that they're just trying to get 8 weeks of payroll. But certainly, if they come out and clarify the other way, we'll be jumping for joy, right?
Yeah, I think and that's exactly right. I do think it's obvious. I do think ultimately this will probably end up being a moot point because of an extension. I think you'll get those number of weeks. But there could be businesses out there, though, that no matter how many weeks that you try to clarify, maybe because of the situation they're in, the lack of, not getting back up to full capacity, maybe they do have this down the road. So but I think the guidance is not coming out yet, because now we have a change in thought process from Congress. And so the SBA can spend a whole lot of time doing all these frequently asked questions, but if it becomes 16 or 24 weeks, so I'm not sure if they're going to come out with any new guidance anytime soon on this, just because of that one reason. So I think to some degree, we're just going to be sitting here saying, let's plan for this for right now, and then let's see what happens in the next couple of weeks.
No, that's a really good point. So let's get to the next one of the next things that they kind of, in the interim rule that came out on May 22nd, they referred to something new called an owner employee. And when they had used this previous, when they talked about the self-employed guidance. So again, self-employed is when you're a Schedule C. And they had come up with guidance to determine how you could apply for the loan. And they'd gone through a lot of definitions and all these kind of stuff. However, now in the interim rule on loan forgiveness, they threw in this owner-employee caveat in here that seems maybe to apply to others besides Schedule C owners. Can you tell us a little bit about this?
Yeah, that's another one that you had to just kind of raise your eyebrows at when you started going through the details of this. And of course, when the interim guidance comes out, and a lot of things they didn't define. If you think back, it took a while for us to understand what an FTE was. Is it going to be 30 hours? Is it going to be 40 hours? And it's not like when the IRS, for example, and I heard this comparison, when the IRS comes out with their guidance, they got all sorts of specific rules and codes that they refer to. Well, the SBA comes out with these terms, and it doesn't relate to anything necessarily. It just says owner employee. Well, owner employee is not necessarily defined anywhere other than maybe past experience with what we think of. And so, they talked about general partners and Schedule C, where it's going to be based on 2019. Then they came out with this owner employee. So we have corporations, S corporations and corporations. Well, they have owners who are employees. And so really in a partnership, you don't have owner employees, because owners of a partnership aren't considered employees or members or whatever, even though they work for the company, or however you want to get really down to really identifying that. But in corporations, you do have owner employees. But so is that what they were talking about? And of course, there's a limit. They said owner employees are limited to $15,385. And then they reference retirement contributions and health care payments for employees being included in that 15.3, or at least that's the way it kind of alluded to it. And we're not exactly sure. That's another question. So before, if you think back to the application, when we did the actual application for the loan, the very first couple of days, there was all this confusion for people who make more than $100,000. Well, did that max out including employer retirement and employer health care? on those people. Well, the guidance came out and said, no, it's not maxed out at that. You get the 15,385 plus those. Now we're getting to owner employees, and it seems to be alluding to that. So we really need more guidance, and this is regardless of what comes out of this Flexibility Act, because this, as far as I can tell, of course, I haven't dug through all the details just yet of that, but from what I can tell, this is not going to be addressed. So this is something the SBA needs to come out and give us more guidance on how to deal with owners on applying this rule.
Yeah, because again, when we applied for the loan, if we included anybody who made over 100,000, they came out with a frequently asked question that said, yes, you can include their health insurance and retirement benefits. So a lot of people included that. And again, it was an average of 2.5 times what those amounts were, that included that in their loan amount. So for them to come back and say, hey, if you're an owner, now you can't include those, you're automatically left most likely with some leftover money you're going to have to pay back, which was just, not what you knew. But again, they wrote the rules as they implemented it. So maybe when they came out with the Schedule C stuff, which didn't include retirement health insurance, they decided, hey, that wouldn't be fair for S Corp owners or C Corp owners either. But we definitely need to frequently ask questions sooner than later as people begin to start doing these applications.
Right.
So, I know in our webinar when we went through the application, we talked a lot about safe harbors, and we got some clarification, which is fantastic, but we still have some confusion over the safe harbors. Can you kind of walk us through that?
Yeah, so just to be very, just kind of slowly walk through it, and that because there's a lot of dates involved with these, and I've alluded to a few of them as well. But two things to remember. The safe harbors kick in if your FTEs go down, your full-time equivalents go down, but you can restore them, or if you've reduced wages by more than 25% for any employee, and then you restore those wage rates back, you can then meet one of these safe harbors. So let's take one at a time. The first is the full-time equivalents. And this is where all the dates start really getting muddy, but you start with your covered period of time. That covered period, again, is when you received your loan, and you have 8 weeks. So what it's going to do is measure your full-time equivalents during that time frame. And so let's just say, if you got your loan May 1st, you're going to have through the end of June basically to measure your full-time equivalents. And that's based on a 40-hour work week. So if somebody works less than 40 hours, you're going to take their average hours they work per week and divide it by 40, and that's your ratio. If somebody works 40 plus hours, they're limited to 1. So the most you can get out of a person is 1. Or there's an alternative method. You can just say if the person's full-time, 1, if the person's part-time, 0.5, regardless of how they are. So that's the full-time equivalent. And you're going to compare that back to one of two periods, either February 15, 2019 through June 30, 2019, or January 1st, 2020 to February 29, 2020. And if it goes down from either of those periods, now you're looking at a potential reduction. So for example, if you were at 10 full-time equivalents in either one of those periods, and you're going to pick which one has the least amount, and that's the best for you, that's what you're going to look at. But if you're less than that, say you were at 10 and now you're at 8, you're looking at a 20% reduction. And so now your forgiveness goes down. But then there's a safe harbor that says, hey, by June 30th, if you've restored that back to 10, it doesn't say what happens a week later from June 30th. It doesn't say, what happens if you restore it a week earlier, where are you at that day? If you restore it back to 10, that FTE reduction goes away, that 20% reduction goes away. Now, in the application, this is where the dates start getting confused, is there's these different measurement periods in terms of applying the safe harbor. There's a February 15th measurement, just that payroll period, including February 15th. Then it measures from February 15th to April 26th. And if that is more, and then it goes into the June 30th date. So there's a process you have to walk through to get that safe harbor. And so, but the main thing to know is if your FTEs during the covered period matches one of the other two periods that we mentioned, you don't even have to get into safe harbors.
Right.
It's only if it goes down, and that's where a lot of the planning is coming in to see where you go. But the application does have a process to walk through, so you just have to carefully walk through and understand what it is. The other piece is the salary reduction. Now, one of the most important things that came out was, I wasn't sure how they were going to do this salary reduction. Was it based on just reducing hourly rates or salary, or was it if I reduced your hours that you would actually have a problem? And it was really based on the wage rate. So if you were paying somebody $10 an hour before this happened, and you're paying them $10 an hour during the covered period, but their hours went down, you're not going to have a reduction based on reductions in salary or wages. It's really based on that wage rate. Now, a salary person, on the other hand, it would, if they were at an annual rate of 75,000 and you reduced them by 30%, yes, you're now they're annualized at some lower amount. Now you have that, but then again, you have the same thing. If you restore that wage rate by June 30th, you will meet the exemption and you won't have an issue with a reduction. So I know there's a lot of dates, there's a lot of confusion. You have to really slowly think through each one to make sure you're going to be okay. Now, if you did no wage reductions, you're going to be fine. Hours, you'll still have to look at if you did hour reductions, and then we can look to see if there's a safe harbor that will help you.
Yeah, and one of the things that I think, particularly if you're a business that pays a lot of overtime or a lot of commissions off products sold or services sold, that is where you may see a salary reduction that you were not even intending, because you did your loan application, you based it off 2.5 times the average payroll for 2019. And if you have workers who constantly always have overtime or have steady commissions, but during the 8-week period, you didn't reduce their hourly wage, but they're not working the overtime or they're not getting the commissions because they're not selling as much, that's where that piece could bite some people without them realizing.
Yes, it's the two concerns going into this were commissions and overtime, because that can definitely reduce the wage. So what businesses are using for a strategy, and it came out in the guidance, you can use bonuses. Hazard pay and bonuses can be applied. In fact, they even said that if you furloughed employees and we're going to try to make up some of that wage from previous time frame, it could end up being paid out as a bonus. So companies are going to use bonuses, hazard pay to make up, to get that effectively that average hourly rate back up to where it should have been, and frankly, it keeps employees whole from where they would have been had this not. Which to me, when you really look at what the intent of this law was to keep employees retained and employed, and hopefully making what they were making before without too much reduction. Now, keep in mind the reduction is 25%, so that's a really large reduction. So. But of course, there's a lot of overtime and commissions and stuff like that. So, but you can use bonuses to try to make up that difference. One thing you can't do is prepay. You still can't get out to the final week and say, you know what, I still have some money left over. I'm gonna pay all of July right now. That's not going to work for that. You'll get that. You'll probably have some issues with that.
For sure. Well, and again, it's really important, and I'll just step back and try and remember the basics, because again, there's so much confusion, is the first part of the loan forgiveness is figuring out how much you spent on the payroll costs and non-payroll costs. You come out with that total amount, do the calculation to figure out what's eligible to be forgiven, and then you might have reductions on that forgiveness amount for your FTEs and safe harbor. So they're two totally different calculations that interplay but are not quite the same, which is kind of interesting. So one thing to caution when we talk about the overtime and commissions, and this could be counterintuitive, is that you could do a bonus to some employees that actually could get maxed out on the payroll cost, right? Because if you bonus them and they make more than $15,385 in the 8-week period, that does cap out on that side of it. So you can't always get to that normal wage rate. So again, this is where planning before your 8-week period, which I know for some of you is right around the corner, is really, really important, just so you understand, and also be prepared that you may have to pay it back, which we tried to caution everybody when they got these loans. But on the flip side, it seems a lot harder to want to give the money back, even over 2 years at 1%, right? They want to maximize what they can do.
Yeah, absolutely. And really where the planning has come in is you've got those companies that have had FTE reductions and they're paying other payroll. And so when you combine all that payroll and then you apply the FTE reduction, it's possible that you've been paying payroll that won't actually be forgiven. And that for some companies, that's not something that they can handle. And so you got to really be prepared when you're making these decisions on how that's going to affect you.
Yeah. All right. So let's kind of move to some dates for forgiveness, because there's been a lot of questions related to this. And again, additional guidance. So we're going off of what we think. One of the big questions has been, as a company or a business, when do I have to apply for my forgiveness?
Yeah. So there's actually nowhere in the guidance that I've seen that specifically says you have this long or you have this until the application came out. And if you look at the top of the application, it has an expiration date of 10/31/2020 on it. So we're kind of making the leap that you have until October 31st at this point. Forget about anything else that comes out. Obviously, if this extends to 24 weeks or some other, that's going to be further out. But at a minimum, for companies that are going to use the safe harbor of June 30, even if you're ending now or coming up in the next week or two, you still have the ability or need the ability to be able to get to that June 30 date if you were planning on restoring your FTEs or your wages over the next 30 days or so. But it appears you'll have at least until October 31st. And then, of course, when new legislation comes out, we'll see. But that's really the only indication of dates on the application side in terms of getting it in to the lender that we've seen.
Yeah, and we're trying to get a handle from different banks of when they're going to actually be accepting the applications, because I know a lot of banks are just starting to have the calls to talk to their teams about how to handle these applications or hiring it out to actually go through the process of approval. And from what I've heard, they're waiting for additional guidance from the SBA on exactly what their role is. So a lot of people who may be coming up on their 8-week period and thought, hey, I'll apply the next day, the bank may not accept it. Right.
Yeah, that's right. And in fact, I was on the phone last week, Friday afternoon, actually, with one of our local bank partners, and they are also in the process of creating the process from the borrower. So yeah, as you mentioned, the SBA did come out and gave interim guidance on what lenders need to do, but there's more clarification they need on that side, as you mentioned. And then how is this process going to actually work with the borrowers? Because you can think about borrowers need to get documentation, need to have it sent in. Portals are going to probably need to be set up. How is that going to be facilitated? And then what's the process going to be from there? So I really don't see any lenders being ready this week, as an example, to start accepting applications. I think you can call and talk to your lender, but I'm sure they're going to tell you just need to hold off for a little bit. And of course, with all this pending legislation out there, there's really no reason to rush in and try to. Now, it's possible you meet all the criteria and you've spent more than what's on the loan, and it won't be an issue. That's certainly going to be for some. Some are going to hit that, and they're not going to have a problem meeting the forgiveness requirements, and they can go right in and won't need these extensions. But for others, they're going to need it. And so for now, I would say just give it a little time and let the lenders work this out, because you got so many thousands of loans out there, and you got to remember, lenders weren't really set up to deal with this, and really nothing was. This is being created, processes are being created as we go. So we've got to have a little bit of understanding for that as well.
Well, for sure, because there are 2 dates that we do know about, is that once the lender receives the application, they actually only have 60 days to turn it over to the SBA, which is another reason why I think if lenders aren't prepared, they may not accept it, because they don't want to take an application and 30 days in still be not, trying to figure out how to do it. And then once that happens, the SBA has 90 days to turn it around and approve it, right? And so we're still kind of looking, if you're less than $2 million in affiliated loans together, there's going to be a much more, the loan application is the same, but you won't have an SBA audit per se. So I'm sure they're trying to figure out from a lender perspective, those two different buckets of what needs to be looked at and how it's going to be handled. But great point to how they're going to receive the information, how it's going to process. I know some banks have already outsourced it to different, whether it's a firm or whether it's a processor to actually do that work, but those groups are still putting it all together as well. So I think honestly, Mike, the easiest one that's going to be is if you're a Schedule C owner and you applied and you got the max of 15,385, you already know what your forgiveness is because you had no other employees. That's going to be the simple ones to process. Right. It's the ones with all the employees and the documentation documentation needed and what you're going to have to submit and what the bank is having to submit. And the other flip side of this is that the bank also, I don't want to say is on the hook, but if they gave a loan that then someone then gives them the application for forgiveness and the person shouldn't, or the business should never got the loan in the first place, that's a whole other decision factor that they have that they're on the hook for. So it's not as easy as it sounds. And so unfortunately for what businesses I think are turning around saying, hey, I've got this application, the package is ready to go, day 2 after my 8 weeks period is over, I'm going to send it to the bank. Just be prepared, like you said, they may not be ready to accept it and to maybe give a little bit of time, which if anybody who owes potentially money back gives a little bit of anxiety. But it may be in your best interest to wait because the guidance or the legislation that may come out may be more favorable to you.
Right. And well, and to add another whole twist to this, I did see a letter that Congress sent to the SBA requesting they revise the loan forgiveness application process for small loans. I think they were trying to define it as under 350,000 to, because, frankly, I mean, we've gone through this and it's complicated. And it's not simple. And again, if you get back to the thought process that it was supposed to be kind of a grant that's 100% forgivable, all of those different criteria to help businesses move on. This application process can be pretty complicated. So there was a request. I'm actually wondering if they'll put something in the legislation to kind of force a more simplified process for small loans. But the SBA, even with the smaller loans, has indicated everything is subject to review. It could get denied. There is a period of time where you could come back and disagree and try to work through that process on a disagreement. But they've got the ability to look at, now will they be able to look at hundreds of thousands of loans and still turn around in 90 days? I don't know. But certainly they've got, they've built in kind of the right to look at any loan. Certainly those over 2 million are going to face extra scrutiny. I know there was even they were trying to pass and I don't think it did, but basically a disclosure for those who receive more than 2 million on their thought process as to why they applied for the loan. And so, I don't think it passed in the House, but this is kind of the next level crazy of this, all these scenarios of just trying to understand, at the end of the day, we just need to know what the rules are. These rules keep kind of changing and kind of evolving over time, and it's like, well, we just need to know what the rules are so we can help companies apply them properly. That's all most companies want to do, is just take what the rules are and apply them properly.
Right. And again, spend them on the right things that are helping people and not just them, obviously themselves on this piece of it. So again, it's funny, anybody I see in the community who knows I'm a CPA, they're like, oh, you must have been really busy with the PPP stuff. So it's definitely getting hit everywhere, from the bankers to the accountants to the businesses. It's a lot to have to kind of go through and make sure the rule is up to date and based off your best guess what advice you to give. So we appreciate everybody kind of tuning in and being patient with us as we kind of, navigate and unpack these rules as they come out. Even with what Mike talked about a lot, is that they could change if, when the House and Senate get together and maybe pass an additional law or guidance that extends it from 8 weeks to 24 weeks. A lot of these points become completely moot, which is kind of interesting. Yeah. So Mike, do you have anything else to add, or are you good for us to wrap up? Is there anything else that I forgot to talk about?
No, I think that really hits everything for now. We'll keep, as we've been doing, as new guidance and new information comes out, we'll keep everybody posted. As always, feel free to send us questions, and we'll be happy to help answer what we can as we go. But as you stated back in the beginning, I definitely highly encourage you to go through our webinar. It's on demand, so you can be at your convenience to see kind of the thought process, how all of this works out.
Yeah, definitely so. And again, if we get additional guidance and something else comes out, we'll film another one. Mike and I love to film webinars, as you know, as we go through this and try and help people go through this piece of it. So again, as Mike said, if you have any questions, please feel free to email us at info@jmco.com, and we'll do our best to answer them. And also tune into our website, www.jmco.com, and our COVID-19 Resource Center, where we have links to all our webinars, as well as additional blogs and resources for information, and we try and keep that as up to date as possible. So thanks for tuning in, and we look forward to seeing you next week.